I think the first point to touch on is the fact that who we are as a business. So we are a global container terminal operator, and that's our real expertise. So what we don't like to do is take any form of risk outside of our core business, really. So that being financing risk, refinancing risk, or duration risk, etc. So for us, we recognize the fact that there was a significant amount to be refinanced in 2017, close to $2 billion. And given the volatility in the market, it's not something that we wanted to encounter at a later stage, really. So we recognized that the market conditions were quite attractive at this stage. So what we did was we managed to kill a few birds in one stone. So we managed to refinance our 2017, a significant part of our 2017 maturities. We managed to extend the duration for another 7 years. And also, because of the attractive market conditions, we were able to lower our financing costs significantly as well. So it ticked all the right boxes for us. The timing was right, and we have a 39-year concession, so it's a very long-term business. So the idea is to try to match the maturity of our debt to our concession as well. So the additional financing gives us more flexibility to support the long-term growth of our business. So just to summarize, we were able to refinance the risk for next year, lower the interest cost, and increase the duration for 7 years as well. So those are the key reasons for the Sukuk.
Well, we have the existing document which we were refinancing was a Sukuk, and it was widely held in this region, and hence we wanted to provide the existing Sukuk holders an option to reinvest in the company and be invested in the credit. And also, given that there is a focus on giving this region an heads up for the Sukuk issuances, we wanted to provide that and also maintain a curve within the Sukuk market, given that we also have the 650 million Jafza Sukuk, which is in our portfolio. And I think this strategy worked quite well, given that about 47% of the final issuance was to the region, and also given the size of the Sukuk, we had a 1.75 times oversubscription on the transaction. When we started off this transaction, we were told that the general market participation rate in this kind of a transaction is between 33 to 50%. So we decided to take the outer limit when we went to the market and hope to reach there. But the feedback was so good and the transaction was so well received that we ended up doing much more than we expected and ended up buying back 1.1 billion of the existing Sukuk. So it was much better than expected, and the 50% was well overshot.
It's an innovative structure where DP World uses a throughput-based capacity, which is measured in TEU. And how it works is that the obligor DP World sells the TEU to the issuer, and DP World would then act as a service agent to sell it at a minimum sale price, and the return that's generated under the portfolio at minimum sale price should be sufficient to meet the amount due under the certificates. It is a very flexible structure, hence it can be replicated throughout other GCC corporates or issuers who are willing to look at Sukuk market as an avenue to raise funding. In fact, it is a structure that has been employed by the airline industry as well as the telco industry. Although having said that, this is the first of its kind in the port industry to be using TEU as an underlying asset. So that's a unique structure, that's a unique proposition of the Sukuk.
I think this deal is a major step towards convergence of the conventional bond and the Sukuk market. Large-scale liability management transactions of this size are obviously very common in the conventional bond market, but this is the first of its kind and the first of this scale in the Sukuk market. So that's obviously a major step, and I think it gives Sukuk issuers the opportunity to proactively manage their liabilities going forward, knowing that this can be executed in the Sukuk market. I think the structure itself is also a major step towards, or a major contributor towards the development of the Sukuk market, because if you are a company that does not have a large fixed asset base or does not want to use your asset base, you have the flexibility to use a capacity-based structure that gives you the ability to come, if you're a frequent issuer, come to the market as and when required and not necessarily be limited by the size of your asset base. Obviously, the fact that the liability management and the new issue are very closely linked to each other made the process somewhat different. Whether it's preparing the Sukuk documentation or preparing the liability management documentation, I think both of these are fairly straightforward, fairly simple, and followed the normal processes, but the actual execution was somewhat more complex because the size of the new issue was linked to the size of the tender offer, and so determining, or there were various permutations throughout the process to come to the conclusion that we ended up with.